Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome to today's podcast. Thank you very much for tuning in, coming back, whatever it is you're doing. I appreciate it. If you guys have liked the podcast, please share it. As always, we need to let others know that this is a possibility and they can do something different. Okay, today, guess what? We're going to talk about the 401ks and IRAs and the stock market. Now, I've had a request to do this, and, I said, well, this is a reason why I haven't done one. And then after I responded to this individual, I was like, well, yeah, it's probably a good podcast of why I haven't done one, comparing it to the market. And it's funny because I do occasionally get people who say, well, Mary Jo, can you compare IBC? Can you compare life insurance to the rate of return in the market? I could, but I'm not going to. And so I'm going to go through the reasons why. And interestingly enough, I had a client I had a first-time conversation with somebody who was really trying to decide what is the rate of return in here and why do I want it? And, it's not about rates of return. And so if we go back to Nelson's book and we really look at Nelson's chapter, The Problem. Now, I think I may have done a podcast on The Problem. I'm not sure, but I believe that I did. Anyway, we all want this rate of return. And the noise in society is you put your money in there and you get a rate of return in the market and you can have this great rate of return and rate of return and rate of return and rate of return, right? And so when Nelson, in his chapter, The Problem, he talks about the fact that we are spending 34.5 cents of every dollar on interest to the bank. 34.5 cents. That is interest on boats, cars, campers, land, homes, combines, tractors, business loans. 34.5% of the majority of households, their money goes to interest at the bank, right? 2, 3, 4, 5%, 6% interest, 7% interest, whatever it is. But then we put a measly, maybe 10% of our disposable income into an IRA, and we say, okay, what are we putting it in? What are we investing it in? What mutual fund? What stock should we buy? And how much is our rate of return? So we save 10% to try to make up for the 34.5 cents or 34% that we have given to the bank. So we're out here chasing a rate of return when we give the majority of our interest to a bank. What? Like, whoever thought that was okay? But that's what we hear. Go give somebody else interest while you take less than what you're paying in interest, you put it in the stock market and you try to make up the difference. How about if we just redirect some of those dollars back to our account and we don't have to worry about a rate of return? So if you're tuning in hoping that I am going to give you some magic numbers telling you that a rate of return in a life insurance policy is a better investment than a 401k, I'm going to correct you on multiple levels. It is not about a rate of return inside the policy, and this is not an investment. This is a life insurance policy at the end of the day that we are utilizing to implement the infinite banking concept. And so if you've read my book and you want to see a rate of return and you are gung-ho about this rate of return and you've not read Nelson's book or you've not apparently read the first half of my book, I encourage you to go back and reread that because we've missed out on the concept. We've missed out on the problem that we're going to the bank and giving them money. Now, the gentleman that I talked to the other day, he is maxing out 401ks and IRAs for this rate of return, giving up liquidity of the money. And then he's going to the bank and he's going to borrow money to buy cows, borrow money to buy land, borrow money for operating. But yet he has all this money in a 401k because it's a rate of return. When we look at rates of return in the market, let's not look at the rate of return in the market versus the policy. Just use your own household. If we are putting money in a 401k or an IRA, and then we go borrow money to buy a home, to buy a car, to a business loan, a cattle loan, an equipment loan, well, you now took some of the interest that you could have had that interest yourself, right? You could have borrowed, even if you didn't use a life insurance policy, and you had $200,000 in a 401k, you could have used that $200,000 yourself and bought a piece of equipment, paid yourself back at 6% and had the 6%. But instead, you went to the market, put the $200,000 at risk, and said, well, I hope it makes me 6%. And then you didn't have the $200,000. So then you went to the bank and you paid them 3, 4, 5, 6% to use their $200,000 so that you could make the 6% in the investment. I know that I said that really, really fast, but think about it. We're putting, at the end of the day, we're putting money in the market and then we're going to the bank and borrowing that same amount of money so we can buy whatever it is that we need. That alone, to me, does not make sense. That doesn't make any sense at all. Why are we doing that? Because we're supposed to be diversified? Are we diversifying ourselves if we are farming and that is a risk, and we're putting money in a 401k or an IRA and that is a risk? Because it's a risk. You might not feel like, oh, this 401k is not a risk. Well, when you're working with your financial advisor, can he guarantee your income in that? Can he guarantee your growth, I should say? Can he guarantee a rate of return? You want me to guarantee a rate of return inside my life insurance policy, but you're asking me more than what you're asking your 401k guy, your IRA guy, right? Your advisor, are you asking him for a guarantee? Nope, because you know there isn't one and you've chose to be okay with that. I am choosing not to be okay with that because it's not okay. I want to know what I'm going to have. That is why I like the infinite banking concept, because I want some guarantees. In addition, let's talk about the fact that if we're going to just look at anything outside a rate of a return, right? And these are the 3 big reasons why I don't even give a crap about rates of return. Because a 401k or an IRA or a CD or whatever it is does not offer me liquidity, controls, and guarantees. Those 3 things are huge. Let's just go over them one by one. Liquidity. I can go to my policy and borrow against it anytime I need it. No question on what I'm borrowing it for. No question on when I'm going to pay it back. None. Zero, zilcho, right? And my money did not stop growing while I did that because I borrowed against it and I used it as collateral. So it keeps earning me any kind of interest and any kind of dividend inside the policy. I keep earning that even while I borrow against it, right? Because I'm using the life insurance company's money. So I have liquidity to do whatever I want with it. If I had that money in a 401k, and I work at that employer, I don't have liquidity to take it out. I can borrow against it, but then they garnish my wages and tell me how I'm going to pay it back. I don't have the flexibility of payback, so I don't have control, right? In the policy, I had the liquidity and I had the control because I could borrow for whatever I wanted. I could pay back for whatever I wanted. So I have control there. So I mixed the two. Apologize. Liquidity and control, right? I have that inside the policy. I do not have that in a CD. If I buy a CD, it's locked up. If I have it in a traditional IRA, I get penalized if I want to take it out before 59 and a half. I have to pay tax when I want to take it out to use it over 59 and a half or whenever. I have to pay tax on the growth. Then that sets my income high. Right now, there's a lot of people wanting to access IRA money, and they're having to figure out, can I do that this year? Due to the whole COVID CARES Act thing, we can take $100,000, but now that's $100,000 of income. I have to pay the tax on that, right? We don't have that problem inside of a life insurance policy either. We can borrow against it. There's no tax implication. So liquidity, I have access to it. Control, I have access to decide when I want to pay it back. How do I want to use it? What do I want to do with it, right? I'm in control. And I have guarantees. Inside of the whole life policy, it is guaranteed to grow every single year. Death benefit and cash value must equal each other at the end of the policy, that being 95 years, 100 years, 121 years. Cash value and death benefit must equal each other. It is guaranteed to grow. So where is that inside of an IRA? Where is it inside of a 401k, inside of a CD, inside of an annuity? We don't have those three things. So if you want me to compare a rate of return to a 401k or an IRA, well, in the policy, I've got X amount of growth, which depends on many factors, right? I've got a dividend, which depends on many factors, but I do have a guaranteed. So I can look at the guaranteed and say, okay, this is what's happening. But what is also happening outside of the policy with the fact that I could borrow against it and go invest in property or buy more cows or buy more land or buy equipment and pay it back plus interest? What's happening with all of that? What does that equal as far as a rate of return? I don't know. It's infinite. Do you get it? Infinite banking concept? It's infinite. All these things you can do. Now you have a product in the market that you can speculate your rate of return. Well, we know what our guarantees are in the policy, and then we have opportunity to do better. We have opportunity to lend money to other people. We have opportunity to create nonprofits, to give to nonprofits, to help kids, whatever it may be. It's not about a rate of return. Are you getting that? When you have a 401k or an IRA, when you pass away, that comes to your heirs taxable. They get to claim that. And I was told by an attorney that this has changed. Now they have to take it out over a 5 or 7 year period of time. Obviously, you want to check with an accountant and the attorney. But if I'm going to inherit an investment, I have so many years that I have to take that money out. Well, isn't that lovely? The government doesn't just let me roll it from generation to generation. If I need it or not, I have to take it so that they get their taxes. So you're going to have to pay tax on that. You're handing that off as a taxable event, where in a life insurance policy, oh man, we haven't even talked about this, but you get the death benefit. Income tax free. Income tax free. Not estate tax free, income tax free. That's a big deal. Now we can roll it to the next generation and even buy more discounted dollars. So if we're doing it correctly, we're buying death benefit for anywhere between 20 cents, even less in some cases, but typically we're at about 20 to 60 cents on the dollar, depending on age. Somebody young is going to be 20 cents. For 20 cents, we buy $1 a death benefit, income tax free. If we're in our 60s, we might be closer to 60 cents on the dollar. So we're buying $1 for 60 cents, income tax free. Show me an IRA that can guarantee that. Show me a 401k that can guarantee that. That guaranteed, I'm going to pay 20 cents and when I die, you're going to give my heirs $1. Income tax free. And then if we keep rolling that to generation, that's powerful because we're not paying income tax. It's growing income tax free. We're utilizing it income tax free. In this scenario, you can go to farmingwithoutthebank.com and I have a blog post called Generational Wealth. You can see what's happening I outline it. I give you illustrations of exactly what's happening if we roll that death benefit from generation to generation. Huge, 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 huge. So should I invest in a life insurance policy or a 401k? Which one's better? Well, I don't know. First of all, you're not investing. Where should you put your money? Do you want liquidity, control, and guarantees, or do you want risk? Do you want to wait till you're 59 and a half? What do you want? Do you want to build an operation today? Do you want to start a business today? Do you want to buy property today? Or do you want to wait till you're 59 and a half to have access to that money? Are you going to have tax write-offs after 59 and a half? So when you withdraw that money, it's not going to put you in a higher tax bracket. This very conversation came up this weekend when I was talking to family and they said, well, now we're in a higher tax bracket because we're not in a higher tax bracket because we're retired, but all of our money is coming to us as ordinary income. So any 401k, any pension, whatever is ordinary income, which is throwing our Social Security off. So our Social Security is taxed again. Double taxation, people. So now we're having to pay tax on Social Security as income. Yup. That's what most retirees are having the problem with. If you are a retiree with money and you've saved and you've done everything correct, you are now being penalized because you did it correct. So shame on you. You should be dependent on Social Security and you should be dependent on the government, or we're going to penalize you by taxing you on every little red cent that comes into your house. So then the question is, should we take the match, Mary Jo? Our employer gives us a match. That's totally up to you. That is 100% up to you. If you want to take the match, great, go ahead and take the match. But look at what are they even paying you in a match? Are they giving you 50% of what you put in? Are they giving you 50% of your income? Are they matching dollar for dollar? And if they're matching dollar for dollar, could you use the money that you're putting in to do something on the farm with? Are you going to work there forever and the match is going to be useful because you're going to work there till you're 59 and a half or 65 and is going to accumulate? Or are you planning to only work there for 5 years and then after 5 years, you're maybe only 45 and now you don't even have access to it till you're 59 and a half without penalty. So now you even lose 10% of that. And the match is still at risk. That's not guaranteed, right? I have some clients who put money in a 401k with the match and it's in a money market or it's in a bond account. It's not in the market. It's not in a mutual fund in the 401k. Then it's a legitimate income boost, right? Because there is no risk if we put it in a bond account or if we put it in a money market account. We've taken it out of the market. Still leaving it in the 401k umbrella is the best I can explain it. But if we have those options, maybe. But I don't know what you want to do if you want to take the match. I have clients that decide they want to take the match, and I have others that say no, they don't. And at the end of the day, it's your money. You get to make that decision, right? Not your financial advisor, not your employer, not me. You get to make that decision, what is best for you. And I'm not going to make that decision for you because this is the problem. We have let the bank run our operation. We've let the financial advisor tell us what to do with money, and we choose to not educate ourselves on any of it. No, that's why I make you read the book so that you understand what you're doing here with me. You understand what you're getting into, and you are becoming the banker. Not me for you, not me, your advisor. You are becoming the banker. So take the responsibility and sit down and say, geez, do I want to do some sort of an investment with it? Could I pay less money to the bank because I'm using cash? Even if you don't put it in a policy, I'm using cash. Now I put it in the market and then I had to go to the bank to borrow money from them because I'm building my retirement at a cost because you have to go borrow money from other people. So the moral of the story here, and I know I've gotten really long, I'm not talking about rates of return. Not going to happen. This gentleman I talked to, very, very nice guy, he really wanted a rate of return. And I can appreciate that. But I'm not giving you a number. We're not talking about rates of return. And so I might not be the best agent for you if you want to look at rates of return, because it's about liquidity, control, and guarantees. And there's not another product that can offer me that, those three things outside of a whole life insurance policy. And on that note, I just want to make it very clear. This is another reason why the infinite banking concept does not endorse universal life, variable life, and indexed, because those things are related to the market. And we don't want to be involved in the market. We don't want our cash value to go up and down. We don't want the indexed return to go up and down. Right? We want guarantees. That is going to show in a whole life product and whole life only. So there are people teaching this concept or a version of it because they all rename it, but they're teaching infinite banking and saying we can do banking with the universal life. We can. If there's no guarantees and what happens with the loan and is it mutual company, are we getting dividends? All those things matter. Okay? I want whole life, plain and simple. It's not sexy. It's just whole life. And a lot of people want complicated, and it's not complicated. As you heard Nate say when I interviewed Nate Bleiler, when you heard Nate say, it's not complicated, it's easy once you stop making it so hard, right? This isn't that hard. We just make it hard because everything's supposed to be that way, yet it's not. So I hope that answered any questions, cleared anything up. But if you want numbers, not your girl, because it's not what it's about. Maybe you want to go see your financial advisor. Okay, you guys, thank you very much for listening. I appreciate it. I would appreciate any reviews, any comments, any concerns. MaryJo@withoutthebank.com. Any new topics, I will take them. Like I said, this was a topic somebody wanted me to address, and I'm happy to do that. So let me know if there's anything else that I can do for you. Otherwise, you guys have a great week, and I'll talk to you soon.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.